Palo Alto reported its earnings yesterday. Now, after market open, it is down around 6%. Wall Street also consider this a buy now. We're going to take a look at this company that Nancy Pelosi herself is heavily invested in. We're going to take a look at a lot of information. We want to see what are the insiders doing, what are the institutions doing quarter on quarter. We're also going to look at the underlying metrics, the free cash flow growth as well as the sales, to understand where is this company heading. And as always, we are going to do an in-depth review, top line revenue growth, bottom line net income, while also looking at the health of this company, their balance sheet, cash versus total debt. And what is interesting with their earnings, they did beat, so we understand where the issues are lying for this company. And we'll also take a look at some slides that are very important in their latest investor presentation just yesterday. As always, not only are we going to run it through the valuation model, so we get to both the intrinsic value and the acceptable buy, but we're also going to take a look at the DCF model in detail, looking at 3 targets, so you can also understand whether or not you do believe this company is undervalued, with a low, medium and high target shortly as well. Very quickly then, we just want to take a look at the earnings, and we can see a double beat with their earnings increasing 20% from the same quarter last year to 132. As we can see, analysts were expecting 125. On top of that, their revenue did grow 15% to 2 billion, and we can see the expectation of 1.97 billion. So a nice growth both in terms of a beat on the EPS as well as their revenue. However, we do see the major reason for this fall is the guidance, something that we will cover as part of their investor presentation. Now, in terms of the stock just as a whole, it is still up around 59% over the last 12 months. And if you have been a shareholder over the last 5 years, you would be up over 300%, so very strong. We also do note one buy rating, although both Seeking Alpha and Quant do give this a hold. This company is trading now towards the midpoint of the 52-week range, and we will touch upon the forward P shortly, right now around 58. Now, in terms of their top line growth, as we just said, it has grown a lot, so is it justified? Top line at least 3 to 7%. However, for a company like this that is trading very high, we want to see a lot more. 600 million in July 2014. 10 years later, 6.9 billion. So it is increasing rapidly, more than 10 times over the last year. And on a graphical basis, a very beautiful graph. We are seeing increased growth over the longer term. In terms of their bottom line though, does it follow a very similar trend? And what we can see here is just purely on a graphical format, very inconsistent. Some years negative, some years positive. So these brackets do in fact insinuate that they were making, or in fact, a net loss year on year. However, we do note in July 2023, we see the first year of a net profit, 440 million. And if they do manage to continue this trend with increasing bottom line, then that will be a very good sign for this company moving forward. When we take a look at the health of the company, total cash versus total debt, 773 million in July 2014, 2.9 billion in their latest quarterly report. Nice to note, over the longer term, their cash is increasing, but as always, pretty insignificant just looking at it in singularity. When we compare that 2.9 billion to their total debt numerically and directionally, we can see whilst it has increased from 467 million in 2014 to 1.5 billion, they can pay off all of that debt with their cash as it is significantly higher. Although we can see the trend over the longer term has been an increasing debt, likewise with their cash. Nice to note, July 22, they did start paying back some of that debt, hence why it has dropped significantly in 2023. So good signs both on the income statement as well as the balance sheet. Now, in terms over the last few quarters, what we'd like to look at is their performance. Over every single quarter over the last 4, they have beat their more recent one by 7 cents, so a very good sign, 100% track record. If we look over the next quarter though, we are anticipating a decrease year on year of 1%, although it is expected to pick back up again over the next 3, with the same quarter where they beat 7 cents, anticipating in 2025 double-digit growth. Now, very quickly, their earnings per share estimates over essentially July 24 as well as July 25 are showing a forward P currently of around 58.6. If they are right in July 25, it will be around 52.22. As always though, this is just part of our analysis and we will consider this when we do look at the valuation. Now, the first grade that we are looking at is the valuation. They do get a D-. Some of the reasons for this as we take a look. PE non-GAAP, well, as we said, 58.62. When you do compare it to others in the industry, 24.52. But again, you can't just justify it off one valuation method. You need to look at other metrics, which is the story that we are building today. Also, other valuation methods, if you do want to take a look, depending at what you like to see. For example, on a price to cash flow forward looking, 35, with others in the sector around 23.74, so they do get a C-. When we do move then onto the growth grade, they get a B+, so a lot better than the valuation. 22.28% on a year-on-year revenue growth basis. Sector median 2.97. So straight away, obviously the valuation is going to be a lot lower. But if you are comparing that to companies that are essentially increasing their revenue by single digit, then it is understandable. On a forward looking, the median sector is around 6.61, with Palo Alto Networks around 18.48%. So that is a lot better. And one of the things that we also like to take a look at, the earnings per share growth over the next 5 years, anticipated 22.41%, with others around 13.8%. So already we are seeing a lot more growth baked into this company as opposed to others in the sector. Profitability grade, well, an A+. Nice to note their gross profit margin on a trailing 12-month basis, 74%, a lot better than the sector median. Bottom line, 30.2%, again, significantly better than the sector median, low single digit. And if you also want to see their cash from operations, another A+, 3.06 billion. As we can see here, the sector median around 93.88. So a little bit mixed. When we do a summary, we can see one buy rating from Wall Street, a double hold from the other two. Valuation D-, growth B+, profitability A+. We can compare their performance against others in the sector over the last year. As we can see, they are up around 59%. That is the second best performing, significantly lower, however, than CrowdStrike Holdings. When we do expand it over the last 5 years, we do note again the second best, up very strongly, 309%. And when we do go over the last 10 years, we do notice it is right up there in the top 3, up 1,267%. Now, do bear in mind that past performance will not indicate or tell us anything about the future, but nice to note they have been historically a very strong performer over the longer term. When we take a look at insider ownership, well, 3.3%. We note 0 instances of insider buying, but 8 instances of insider selling of over 295 million. Pretty much every single quarter, we do note significant amounts of insider selling. As we can see here, the more recent one around $63 million. When we take a look at who this was and the date, we can in fact see the EVP on the 6th of May, so just a couple of weeks ago, sold over 121,000 for an average share price of just under $300, and we can see a very significant amount. As always, do let me know if you consider this to be a bearish signal. For me, they will continue to sell. It could be personal financial reasons. We aren't privy to that information, but as always, information is here. No buys to report as well. When we take a look at institutional ownership, just under 80%, 23 billion worth of sales, so quite a significant amount, and a lot more than buys. We see 15 billion worth of buys over the same period, and in fact, also in the more recent quarter, we do see more selling by the institutions than buying. So overall, a lot of selling, both by insiders as well as institutions who have been selling a lot more over the last 12 months, as well as in the more recent quarter. But remember to always do your own due diligence and not just copy any of these movements. Also, we want to let you know we have released our latest free weekly article where we run through 20 undervalued dividend stocks for you to consider in the portfolio. If you want to gain access to this or any others, all completely free, do click on that pinned comment below. You can start reading straight away. And this article here, if you do want to take a look at the websites and resources we use, we do detail all that information as well. So let's jump into their fiscal year 24 Q3 earnings call, which took place just yesterday. A few things that we do want to point out: their total revenue is up double digits, plus 15% year on year, which the market did like. However, one thing that the market didn't like, and another reason for, in fact, that drop to their share price, was their total billings, which is only up single digits, 3% year on year. One thing that I always quite like to see at a very high level is the revenue growth, which we see double digits, but also the margins growth, which we can see here, 200 basis points year on year. So that is very strong if a company not just increasing revenue, but also the margins. And what we can see here as well, adjusted free cash flow up on a year on year trailing 12-month basis. Also the EPS. So lots of good news, but as we can see, markets would have liked to see the billings a lot higher into the double digits that we have seen for the other metrics here on show. Of their companies and their customers, what we do want to point out, as we can see, they are increasing a lot of deals. In fact, their over 1 million accounts in quarter 3 is up 22% year on year, over 5 million up 17% year on year, and over 10 million accounts in Q3 up 28%. So they are continuing to increase a lot of large deals up significant amounts, which is helping drive their top line revenue. And at the same time, not only are they increasing these accounts, they're also increasing their margins, which will help with their overall profitability, which they have struggled with over the last few years. In terms of their guidance, very important to understand how they are going to perform. Now, over the full year, their total billings anticipated around 10 to 11% year on year. In terms of the revenue as a whole, 16% year on year. We'll cover this shortly as how they've done over the last 10 years. And operating margin, we do like to see growth in that, and they are anticipating some increase as well, 270 to 290 basis point increase year on year. In terms of earnings per share, well, very solid, 25 to 26% as well, and their free cash flow margins that we will cover shortly, looking very high in the very high 30%. So lots to like about this company, but as always, you do want to understand whether or not the valuation is there, and that is what we are coming to in today's episode. Now, free cash flow per share, do focus on that as earnings is susceptible to manipulation by management through accounting. We want to invest in companies that have consistent increases to their free cash flow year on year. 23 cents per share in 2014, 868 in 2023, expected to continue into 2024, 952. So a very good sign already that this company is able to increase those free cash flows. And as we just saw from their guidance, this is expected to continue into the full year 2024. Sales growth now strong double digit every single year. Granted, it is expected to slow down. Still, if they can continue the trend of double digit growth, this will still be very positive for their top line moving forwards. And we can see numerically going from 600 million in 2014 to 6.89 billion in their more recent year. Now, on this channel, we love companies that do share buybacks, returning excess cash. What we do know, however, they would have diluted your position over the longer term. However, it is very marginal, 223 million to 342, and at the same time, the share price has increased significantly over the same period, so maybe it wouldn't be something you would worry about in this instance. ROIC, now one of our 7 metrics that we love to look at, what we would say is 10% or more to give us faith management are able to effectively allocate their capital. Over the last 10 years, 9 of them we know negative. As we just ran through, they did make a net loss, hence the negative percentage. Nice to note, a full year of positive 9% in 23, trailing 12-month basis 11%. So hopefully they have turned that tide and we can continue to see net income moving forwards. And again, this just shows that again, 6% to the operating margin. Ideally, we do want to see a minimum of 12%. Nice to note though, it is increasing on the trailing 12 months to 9%. And free cash flow, a proper free cash flow machine. 43% in 2023. They're anticipating around 38 to 39 in 2024. So that is looking very good. Love to see this metric this high as well. A very good sign, making it incredibly attractive to potential investors as well. In terms of the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, remember these are the number of years it would take the company to pay off all of that debt net of cash on hand. 0 indicating it won't even take them 1 day, correlates to their balance sheet, so it does show they have a very strong balance sheet. So this is definitely a company that you do want to consider for the portfolio if the valuation is there. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So we have the DCF model, the free cash flow year on year, absolutely insane growth, 86.93% on average, just last year up 47%. Now what we're going to do is take a lower rate of 14% with the discount rate to get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. As we can see here, this would give an undervaluation signal with a price target 356.74. Now, as we can see, and as we mentioned, this is the low growth of 14%. If we go to a medium of 16%, as we can see, the intrinsic value would be just under $410, and this would give implied upside of 37%. If you believe that is too low, given the average as well as just the last year at 18%, as we can see, would give an intrinsic value of $470, and that would then give us upside of around 57%. Just remember though, you can grab a copy of this model. It will be able to play around with it. You can use your own estimates and judgments to get your own intrinsic value, whether it's for this company or others, by clicking on the pinned comment below. So in today's episode, we are going to be a lot more conservative. We can take forwards to the next slide, the 14%, which does give us an intrinsic value of $357. So the intrinsic value, typically on this channel, we do use all 4 models which are relevant to the company. Today, only the DCF model, hence why we get the intrinsic value of 356. Now, current price is sitting around $300, although it could move around today given the fact that it has reported the earnings and it was dropping over in the after hours once it had reported. Margin of safety then, 10% is what we always start off with, and we only execute if it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, a buy up to 321, then we keep going till it's near the current trading price. So pretty much we see a 15% margin of safety for this company based on our estimates and judgments up to $303. In terms of Wall Street and their price target, well, over the next 12 months, they do see upside of around 22%. 365 is what they envisioned over the next 12 months. But as always, let us know your thoughts in the comments. Like Nancy Pelosi, is this one that you are also buying, or is this one that's on your watch list and maybe waiting for a lower entry? Let us know your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.